The mortgage industry has a dirty little secret, and it's that almost nobody, not the banks, not the Fed, not the economists with the fancy titles, can reliably tell you when interest rates are going to fall. Yet here we are, millions of homeowners glued to financial news feeds, refreshing mortgage calculators at 2 in the morning, convinced that this times is the month everything changes. Let's rewind to 2022 and 2023. When rates shot from the threes all the way past 7% in what felt like a financial jump scare nobody had on their bingo card. The Federal Reserve was playing whack-a-mole with inflation, swinging the rate hammer hard and fast, and every homeowner who'd locked in at 3% suddenly became the most insufferable person at every dinner party. Now here's the macroeconomic machinery running under all of this. The Fed raises the federal funds rate to cool consumer spending, which ripples into mortgage rates through the bond market, specifically the 10-year Treasury yield. Think of it like a thermostat in a house where the Fed controls the temperature. But the mortgage market is 3 rooms away, and the vents are leaky and inconsistent. The optimism of late 2023 was real, and infectious analysts were calling for 6 cuts in 2024. Markets were pricing in a pivot, and financial Twitter was basically writing victory laps before the race even started. Then came the stubborn inflation data, the hotter than expected jobs reports, and suddenly those 6 cuts became 2, then maybe 1, then a collective shrug emoji from the entire economics community. And psychologically, that whiplash does something to people. It breeds a kind of rate-watching paralysis, where homeowners become so fixated on timing the perfect refi that they end up doing nothing at all. Barry Habib, one of the most respected mortgage strategists in the country, has said for years that waiting for the bottom is a fool's errand. And yet every comment section on every mortgage video is full of people saying they're waiting for 4s. Here's the uncomfortable history lesson. Rates have been above 7% for significant stretches of the 1980s, touching nearly 19% in 1981. And people still bought homes, still refinanced, and still built wealth. The myth that there's one magic rate you should be waiting for is a story we tell ourselves to justify inaction. And inaction has its own very real cost. The predictable cycle here is actually textbook rates rise to fight inflation. Inflation cools, unemployment ticks up, the Fed pivots, rates fall, and the refi boom begins, but the timing times of each phase is where every forecast goes to die. Reddit's mortgage communities, financial advisors, and even institutional traders have all at various points called the pivot with embarrassing inaccuracy, and yet the crowds keep gathering around every CPI report like it's a sports championship. Let's kill the biggest misconception right now. Refinancing isn't only worth it when rates drop dramatically, and waiting for a 2% improvement is outdated conventional wisdom. A break-even analysis dividing your closing costs by your monthly savings is what actually tells you whether a refi makes sense, and sometimes a half-point drop pencils out beautifully, depending on your loan size and how long you plan to stay. So what do you actually times with all this uncertainty? Because that's the real question, isn't it? You build a trigger, not a wish. Decide right now at what rate you will refinance, calculate your break-even, know your timeline in the home, and when the rate hits your number, you pull the trigger without hesitation and without waiting to see if it goes lower. The disciplined move is to stop treating a refinance like a stock trade, where you're trying to catch the exact bottom, and start treating it like a business decision with defined criteria and zero emotion. Position size matters here too. Don't over-leverage a cash-out refi, chasing rates when the equity you're pulling could evaporate in a market correction. There's a philosophical truth buried in all of this rate drama that goes beyond mortgages. The people who win financially aren't the ones with the best predictions. They're the ones with the best process. Consistency, clarity, and a willingness to act decisively within a defined framework will outperform brilliant market timing almost every single time. And honestly, if rates fall to the 5s and you refi and then they drop to the 4s, great, you refi again, because you're not married to a rate, you're married to a strategy. The goal was never to be right. The goal was to keep your costs rational relative to your financial life at each moment in time. You can be completely at peace not knowing exactly when rates fall, because you've already defined the conditions under which you move, And that preparation is worth more than any prediction. The irony of all this rate watching anxiety is that the answer was never in the forecast, it was always in the framework. Check out our links in the description below. Whether you're looking to get started in real estate investing, need home contracting work, or want help finding the right lender, we've got resources to help you take that next step with confidence.